Good morning to the B.F. Anderson Technical Report for October the 7th. Many years ago I was given advice that I use today, and I think it's important advice. The market focuses on only two things: interest rates and corporate earnings. And unfortunately, we had the Great Recession back in 2007 through 2009, and during that period where the market declined so dramatically, over 50%, the primary culprit was corporate earnings. We had 9 consecutive quarters of declining corporate earnings. Now, the thing to understand about corporate earnings is that when the S&P 500, which is the generals, when the generals get sick, everybody else catches a cold. So unfortunately, what happens with declining earnings and declining revenues is that it has like a black cloud that hangs over the entire market. Well, the good news is that it appears that earnings are starting to turn. In the third quarter, it is estimated that S&P earnings are only going to be down 0.5%. Now, if you take energy out, we go positive. So energy's still in a funky way, and it does appear that there are some turns here. Now, where we see the strength is clearly in technology, and what really could turn the earnings around is revenue growth, because we're seeing strong revenue growth. Now, in internet software and services, third quarter projection is up 21%, semiconductor equipment up 23%, semiconductors up 11%, hardware up 6%. So we're seeing an increase in revenues primarily in technology, but we're still, again, seeing weakness in the oil patch, but that is projected to improve. So the main thing that I'm trying to say here is that we've been in an earnings recession. It actually got started in 2014. We are now in the 5th consecutive month of declining revenues and earnings, but I will say, to correct myself, revenues this quarter will be up. So we're looking for an upturn in earnings, and we could see a surprise where maybe things aren't down 0.5%. It's awful close. We could actually go positive. But this has resulted in what I call a mini bear market. In 2015, energy stocks dropped 50%. Biotechnology stocks dropped 40%. Financial services, financial stocks dropped 30%. Small cap and mid cap stocks dropped about 25%. So that was a bear market that we believe got started in second quarter of 2014. I do believe that bear market ended in February of 2016, and as we see earnings recoveries, we should see an improvement in investment activity, especially the stock market. Now, let's look at some charts. Now, on this particular video, I decided just to do some random charts to kind of discuss the concept of fear and greed, because if you think about earnings and interest rates go down because there's a lot of fear, because there's a lot of demand for bonds, which we would consider a fear asset. So what I wanted to do is look at some fear assets and look at some greed assets just to see if the market is telling us that this recovery seems to be happening. So the first graph I want to look at is the Dow Jones U.S. Railroad Index. Now, this is a component of the transportation index, but if you think about it, what's going on here, you have the Dow Jones Industrials, which is 30 cyclical companies, mainly manufacturing. So when you see the Dow doing well, you don't want everything sitting on the shelf. You want the products moving around the country and moving around the world. So the railroads, in a way, are, to me, a better way to see if manufacturing is translating into revenues and sales. Well, as you can see here, the railroad index has really broken out here and is looking very strong. So to me, that would be a confirmation of some sort. Now, this can change tomorrow, but that would be a confirmation that the economy is picking up. Now, another index that I think is interesting is the S&P 600 Small Cap Index. it is actually holding up better than the S&P 500. So if the small stocks can get going, again, that's a nice confirmation. Now, one thing I do want to mention here is interest rates. We do have the jobs report this morning. The 10-year Treasury right now is at 1.75%. Now realize, as I've said many times in the past, that these interest rates are the lowest they have ever been. They are lower than the Great Depression. They're lower than the Civil War. And what you have to realize is that this drop in interest rates since '07 is all fear, because the demand for bonds has been so high. And so what's starting to happen here is, we made a low back here in 2012, looked like we were coming into recovery. Earnings recession hits, brings interest rates back down again. We've made another low, but very interesting that we're on the verge of breaking the 200-day moving average, and as of this morning, we're at 1.74, 1.75. It breaks the 200-day at 1.76. So I would say the main area I would be looking at on interest rates would be a break above 2%. If that does happen, I really believe the Fed will be in a more of a position to raise rates. Now, this is the S&P, and I went back to 2015 because you can just see that the market has been just moving sideways. Now, in an earnings recession, that's just what happens. We were hit hard here in September of 15. Slight recovery, hit hard again here in February, but it now looks like a recovery is underway. However, the S&P is not doing as well as the NASDAQ, which is more of an earnings-driven index. You can see that the NASDAQ is actually breaking out, hitting all-time new highs, which is very, very positive. This could be a new bull market being driven by corporate earnings. That's a real bull market. Now, one of the strongest areas in the market is anything to do with e-commerce. This is Amazon. Beautiful situation, nice company. But I do want to mention a Chinese company because the Chinese stocks are really starting to look interesting. And again, that's another earnings, somewhat of a greed asset. You can see Alibaba came public just 2 years ago. Now, this is a primary difference between Amazon and Alibaba. Amazon went public in 1997. It's been out there a long time. A lot of people own it. It may even be what some people would say over-owned. I mean, there's just every mutual fund out there has it. People that I talk to that normally don't discuss stocks always want to talk about Amazon. So it kind of may be a little over-owned here. But I think Alibaba, you can see it went through what you call the IPO droop. Now, what this is caused by, I believe, is uncertainty of insider selling, because you have the founders of the company, which are usually venture capital firms and individuals and so forth, that start the company, and the primary objective of an IPO is to give liquidity to the shareholders or the owners of the company. So it made the IPO, rallied like most of them do. You always want to wait 6 months. It goes through the droop. You get the insiders out of the stock. Now, if the fundamentals of the company are good and they're real, you'll get this recovery. So Alibaba looks interesting. Now, here is a fear stock, I would call. This is called Clorox. This is basic stuff. I mean, we're talking, stuff you wash clothes in. These types of stocks have done real well while interest rates have been dropping, while there has been a lot of fear. But my gosh, when I looked at this chart the other day, I was just shocked at how much this stock is starting to deteriorate. So that kind of tells me maybe we're moving from a fear environment to more of a greed environment. Now, another example would be the electric utility stocks. Everybody's got to have utilities, correct? Same kind of thing. The utility stocks have been outperforming for the last 2 years. Well, then all of a sudden, boom, we're getting this breakdown in utility stocks. Now, one thing to realize about dividends, and this is a dividend-paying stock, dividends are very different than bonds or CDs. Bonds and CDs are where you're lending money and you will be paid back, you will be paid interest on the money, and then you'll get your money back at maturity. With a stock that pays a dividend, you have to realize that the dollar amount of the dividend that's being paid to the shareholders reduces the shareholder equity by the amount of the dividend. So it's different. It's not the same thing. Plus, when you go into a dividend-paying situation seeking income, you're taking a business risk. So the breakdown in utilities is kind of telling me that maybe interest rates are going to be heading up, because that's not what you want to see. Now, another fear asset. This is the gold stocks. You can see what's been happening to gold here, which has been quite dramatic. Now, China. This is called the PowerShares Golden Dragon portfolio. It's a good index of what's going on with Chinese stocks. Now, you have to realize China still has the fastest growing GDP in the world. They are now considered the second largest economy in the world behind us. Now, one thing that's always on the mind of most investors that invest in China is, are the accounting rules the same? Well, you should only invest in Chinese companies that are what you call ADRs, American Depository Receipts. These are Chinese companies that trade in the United States that have to meet all the accounting standards of U.S. companies and the SEC. So just realize that on Chinese stocks. Now, you can see here that this is really breaking out, making new highs. Again, that's another vote for the growth group. Now, here's a Chinese company. This is Weibo. This is the Facebook of China. Facebook, Twitter, however you want to call it. But again, you can see a powerful breakout. So in conclusion, it appears that earnings have been in a really bad way for the last 2 years. This has caused the market to just not go anywhere. It's been not a good market. And if the earnings recession ends, that could be a very dramatic change, and let's just see what happens. But if you have any questions, don't hesitate to call. Thank you.